Thanks so much for joining. Today I want to spend 5 minutes on introduction to income statement. I feel many students and young professionals still don't really get what the income statement does. So when we talk about an income statement or profit and loss statement. It basically reflects the operational performance of a company. And what we do is we start with revenue, sometimes sales or even turnover, especially in UK, revenue, sales, turnover. It's usually when we talk about a product, it's price per quantity. That's what you generate. Then you deduct cost of goods sold or cost of sales. And then what you have is your gross margin or gross profit. Then what you deduct is your OPEX or SG&A, sales, general and administrative costs. Then what you have is EBITDA, earnings before interest, taxes, depreciation and amortization, minus depreciation and amortization. Then what you end up with is earnings before interest, taxes. Now, very important, but I will come to this, interest. Then we talk about EBT minus taxes, net profit or net income or earnings. And then not necessarily part of the income statement, but just for illustration purposes, quite important, dividends. And then retained earnings. So if you go through, I don't want to look at this from an accounting perspective. I actually want to give you a bit of idea what you can get out of this. So first, up to this point here, this is all business model related. So in finance, this is basically the operational performance of a company. Here you can't do much. Here you can really say, okay, are we able to sell products? Do we have the right price? What is our cost structure, direct and indirect costs, to derive to your operational performance. In accounting, yes, we call EBIT operating profit in accounting. But really from a finance perspective, this is the key part that gives you an idea whether the business model works, what the value of your business is. That's why many times in M&A transaction we talk about multiples, 6 times EBITDA, 10 times EBITDA, because here you can really compare companies. Everything that happens here is more from a financial lens. Everything here. And here, this changes with accounting policies. This changes with your leverage. The more leverage you have, the more interest you pay, the less taxes you pay. D&A, what is your depreciation amortization schedule? Is a straight line depreciation. Dividend policy, taxes. So here you can change internally a lot, which makes it harder to compare companies with each other. So just as an idea, first part, operational performance, EBITDA, very important. Then another part, if we look at the two cost items, cost of sales and SG&A, many people say one is the variable part, the other one is the fixed part. That's not correct, because even in SG&A you can have some variable components, some temporary cost items. What I think is more correct is if you think about those two cost items as direct and indirect. Yeah, so cost of sales, cost of goods sold, they go into the production process, raw material, packaging, and so on, whereas SG&A is back office cost, leases, laptops, IT systems, and so on. Yeah, depending on the business for sure. D&A, it's a non-cost, non-cash item. This is purely from a tax perspective and accounting perspective. This is your depreciation of fixed assets. And then really important, please have this in mind, interest is what you pay to your debt holders. Taxes is what you pay to the government. And dividends, it is what you pay to your shareholders. Yeah, not only there are other items and how you can pay shareholders via share repurchase, and then retained earnings actually goes into the balance sheet. Yeah, just an idea, quite simple. We use this as a starting point for other valuation purposes, but just to make it simple, that's how an income statement looks like. Thank you so much. See you later.